Silver prices witnessed extreme volatility on Monday, crashing nearly 8%, 21,000 rupees per kilogram, on the Multi-Commodity Exchange, MCX, after touching an all-time high earlier in the day. The precious metal fell sharply from 2.54 lakh rupees per kilogram to around 2.33 lakh rupees, rattling investors and traders alike. Silver opened the session at 2.39 lakh rupees per kilogram and surged rapidly to a fresh lifetime high of 2.54 lakh rupees, driven by strong speculative interest and safe haven demand. However, the rally proved short-lived, as heavy profit booking and forced selling dragged prices down within an hour. Market experts attribute the sudden crash to a combination of geopolitical developments, stretched technical indicators, and higher trading margins, which together triggered a sharp correction. Key reasons behind the silver price crash: 1. Easing geopolitical tensions, reduced safe haven demand. The most immediate trigger for the sell-off was optimism around a potential end to the Russia-Ukraine conflict. U.S. President Donald Trump stated on Sunday that peace talks with Ukrainian President Volodymyr Zelensky were progressing, and that both sides were very close to a deal. Silver, which had benefited from geopolitical uncertainty as a safe haven asset, saw investors quickly unwind positions as risk appetite improved across global markets. This shift led to aggressive selling pressure. 2. Overheated technical indicators signaled a correction. From a technical standpoint, silver prices were trading nearly 89% above their 200-day moving average, DMA, a level historically associated with sharp corrections. Analysts point out that during previous rallies, including 1979 to 80 and 2011, such extreme deviations were followed by steep declines of 20 to 30% initially, and in some cases 70 to 90% over time. This prompted traders to book profits as prices approached unsustainable levels. 3. CME margin hike forced position liquidation. Adding to the pressure, the Chicago Mercantile Exchange, CME, raised the initial margin on silver futures from approximately $20,000 to $25,000. Higher margins required traders to maintain more capital, and many leveraged participants were forced to liquidate positions. This margin-driven selling intensified the fall and accelerated the intraday crash on MCX. Despite the sharp correction, experts maintain that the long-term outlook for silver remains positive, supported by industrial demand from sectors such as solar energy, electronics, electric vehicles, and battery manufacturing. According to Jigar Trivedi, analyst at Reliance Securities, silver is likely to remain volatile in the near term, though the broader trend remains intact. Meanwhile, investment firm BTIG cautions that if silver prices slide towards the 50-day moving average, DMA, a further correction of 25 to 30% cannot be ruled out over the next 1 to 2 months. The Multi-Commodity Exchange, MCX, is India's largest commodity derivatives exchange and plays a crucial role in price discovery for metals like gold and silver. What is traded? Commodities such as gold, silver, crude oil, copper, and agricultural products. How it works: mostly through futures and options, allowing traders and businesses to lock in prices for future delivery. Regulator: operates under the Securities and Exchange Board of India, SEBI. Who uses it? Investors, traders, jewelers, refiners, and industrial users to hedge price risks. MCX prices often serve as the benchmark for physical silver rates across India. Monday's sharp fall highlights how quickly sentiment can shift in commodity markets, especially when prices rise too fast. While silver's long-term fundamentals remain strong, experts advise caution in the short term, as volatility and corrective moves may continue.